It is a crisis, and I think it's very much akin to the crisis that we saw, well, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, they will do the same. They will have to panic and cut interest rates. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts, and it's very pernicious.
On Monday, investors were sent into a spin when major global stock indexes, including the S&P Index, Seoul's Kospi Index, and the Nikkei Index in Tokyo, experienced sharp sell-offs that raised concerns of an impending global recession. One of the key triggers was the unwinding of the yen carry trade. For years, investors took advantage of Japan's near-zero interest rates, borrowing yen to invest in higher-yielding assets elsewhere. However, when the Bank of Japan raised interest rates and the yen appreciated, many traders scrambled to close their positions, leading to a widespread sell-off. This financial turbulence was compounded by concerns over mixed U.S. economic data, which sent conflicting signals about the economy's health. The activation of the SOM rule, an indicator predicting potential recessions, heightened fears of an economic downturn, despite some positive signs, like GDP growth. The tech sector also played a crucial role in the crash. Disappointing earnings from major tech companies such as Amazon, Microsoft, and Tesla triggered sharp declines in their stock prices. Given that the market's gains had been heavily concentrated in these tech giants, their faltering had a disproportionate impact on the broader market. Together, these elements sparked a dramatic sell-off, leading to a significant market crash. Many experts view this as a potential market correction, rather than the onset of a prolonged financial crisis. However, Alasdair MacLeod, a prominent precious metals analyst and head of research at Gold Money, believes this is, in fact, the beginning of a prolonged economic decline in the style of the Great Depression that will negatively impact major economies worldwide. According to Alasdair, a respected personality in the precious metals and resource sector, Monday's sudden decline is the crash before the crash, a smaller crash that precedes a bigger, more prolonged one to prepare the market for what's coming. In a recent interview with Liberty and Finance, Alasdair discusses the many similarities between the months preceding the Great Depression in 1929 and recent events. As we present clips from the interview, please like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video.
Individual events occur, and you're right, it's difficult really to assess the importance of those events until they play out. But I think by far the most important thing to understand in terms of market valuation is the disconnect between bond yields and equity indices. Usually what happens towards the end of a bull market in equities is that you find that economic conditions are such that interest rates have already started rising, bond yields have already started rising. A tension develops between the valuation of the equity markets and the bond markets, and it sort of pulls apart like that, and then suddenly it snaps. This is, I think, what we're seeing. If you chart the 10-year US Treasury yield, invert it and put it alongside the S&P, you will see that an inverted yield and an S&P generally correlate pretty tightly. There have been exceptions. The first big exception was the dot-com bubble, and in the years following that. The second big one was COVID, where with the suppression of interest rates to the zero bound, the yield on the 10-year US Treasury just collapsed down to less than 1%. The third one, which is the one we're in now, is the biggest disconnect in terms of valuation that we have seen in history. Now, it is closed a little bit with the yield on the 10-year US Treasury coming off a little bit, and at the same time, the S&P 500 itself coming off a little bit. So that gap has closed a little bit. We are now in a situation where having the S&P having continued to sort of climb while bond yields were climbing, that disparity is so great that the snap is now in place. It's just a question of what triggers it. And what has happened is that the institutions in Japan, in particular, over many years have sought higher yields abroad by investing in foreign bonds, particularly US Treasuries, and also some of the European bond markets as well. They have also invested quite a lot in US equities. So we have this situation where, with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup, really, of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. And then everybody got wind, if you like, that the Bank of Japan was going to change its policy and actually raise interest rates from 0.1% to 0.25%. Wow, what a shocker. But what it did was it triggered an avalanche of reversal of the carry trade, as suddenly there were huge losses on the capital side of the carry trade, particularly where people actually hadn't covered for the exchange risk. And at the same time, you were finding that the Japanese pension funds and insurance companies were making, I mean, they were facing quite big losses where they were going out into term debt. And so really what they were doing is they were trying to liquidate their foreign positions as the currency was recovering, because the currency was wiping out any profits that they had or making their bond losses even worse. So they were basically selling dollars, buying yen.
While there's still some debate about whether the unwinding of the yen carry trade is over and whether it poses more risks to the markets, Mark McCormick, the global head of FX and EM strategy at TD Securities, recently shared his thoughts on the issue. McCormick emphasized that this process is both tactical and deeply rooted in the structure of the financial markets. He pointed out that over the past decade, Japanese investors, particularly pension funds, which account for about 80% of Japan's GDP, have heavily invested in foreign markets. These overseas investments are a significant part of the carry trade. I do not think the carry trade unwind is over, McCormick began. I think we have a long way to go. I think you need to think about whether it's kind of tactical and the structural nature of it. The structural nature of the carry trade is that for pretty much around the last decade, Japanese investors have put their money, mostly pension funds, which accounts for about 80% of GDP in other markets. So the assets that they're tracking in other markets are actually a big form of the carry trade. Alasdair MacLeod expects more unwinding too, not just of the yen carry trade, but several other sectors of the global economy. Let's get back to the video.
The selling of Japanese institutions' interests came at a very difficult time for the US market, because it was about that time there was some disappointing earnings coming through from, the Magnificent Seven, the top tech companies. And so you had this combination, if you like, which was driving down equities. And it is a crisis. And I think it's very much akin to the crisis that we saw, well, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, and in late 1929, the Fed actually did pretty much what it would do today. It went into the market and bought US Treasuries to keep interest rates down. It made reserves available for the commercial banks so that their balance sheets they will do the same. They will have to panic and cut interest rates. My guess is after we've seen something like a 30 to 40% fall in the S&P, they will cut interest rates. I can see the meeting, emergency FOMC meeting today. When that happens, I think markets will steady. This is what happened from around about November 1929 and ran through to around about May to June in 1930. Then the market started its pernicious decline from having rallied regained about half the initial fall. You then had this long, pernicious decline down to a low level where the Dow fell roughly lost 90% or 89% from the top by mid-1932. I won't describe the crises that came with it, like banks failing and all the rest of it. This is the sort of thing which, we can envisage being repeated today. But you can see that the structure of the market, of the bear market, is actually quite clear in advance. We can see this in advance. So to summarize, you've got the initial crash where everybody throws their toys out of the pram. We all get terribly worried. Banks start worrying about the value of the collateral they've got against loans, all that sort of stuff. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts.
As each day passes, the state of the US economy increasingly mirrors past periods of significant financial strain, such as the 2008 Great Financial Crisis, the high inflation and interest rates of the 1980s, and even the late 1920s before the Great Depression. With a debt-to-GDP ratio of 130%, the United States ranks among the most indebted nations globally. Experts anticipate that the economic situation will intensify in the coming years as the US accumulates more debt and faces rising debt expenses. Some predict that the US is following a path similar to Japan, which has a staggering debt-to-GDP ratio of 260% and is teetering on the brink of a sovereign debt crisis. Alasdair firmly believes that returning to the gold standard is the only way to prevent a catastrophic collapse of the global financial system. According to him, only those who invest in gold and silver now will be prepared to survive the economic upheaval ahead. We'd love to hear your thoughts on Alasdair MacLeod's predictions for the US dollar, gold, and the global economy in the comments section below. Don't forget to hit the like button, subscribe to the channel, and turn on notifications for more videos. Thanks for watching, and we'll see you in the next one.